Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Welcome back, everybody. Today, our special guest is Reece, who is a real estate investor with a different kind of focus. It's not multifamily, it's not self-storage, it's not industrial, it's not residential. It's all around legal grow ops, legal growing of marijuana, of cannabis. That's what he has created his real estate business all about. And he's doing pretty darn well. And we're going to talk about how it all works. So, Chris, welcome to the show. Great to have you.
Dave, thank you so much. Great to be here. Really looking forward to going through the story and sharing some insights.
Well, let's simplify it for this dumb, simple brain. All right. So, I got my head around multifamily investing, single family investing, all these different kind of investment classes. Explain how your investment class works, if you would, just like you're talking to a 12-year-old, not very bright kid.
which we're going to use you as the example, right? Well, Dave, it's actually interesting. So the whole cannabis industry within the United States is a very fragmented industry. And because cannabis is illegal still at the federal level, you can't go to a local bank or even a larger bank and get a mortgage for a property. And so I identified this high demand and scarcity of capital 46 months ago when I launched the fund. And the whole thesis behind it is that you have cannabis as one of the fastest growing industries within America without traditional access to banks, and there's limited institutional involvement. So you have those three characteristics that ultimately allow us to execute on our strategy, which is very simple. All we do is we finance through a senior mortgage, either an industrial, so think of a cultivation, or retail, think of a dispensary. And we've done 35 addresses across 11 states since we launched. And it's very simple, and it helps our investors diversify their real estate exposure or pick up additional monthly income.
Okay, great. So so you got kind of two categories that you invest the funds in. One is the actual growth of the cannabis, how it's grown. The other one is how it's sold, basically, right? So let's take a look at the grow side of things. A lot of us, myself in particular, don't have the faintest clue about how that side of the business works. So maybe explain that. When you're offering somebody financing for one of these facilities, how does the business behind that work?
Yeah, it's actually really interesting because within the United States, we have approximately 40 states, DC, and 3 US territories that have at least a medical program. And so cannabis is either it can be medical or it can be recreational or what we call adult use. And it's interesting because you can't cross state lines. Any state that has a program needs real estate to grow, process, and sell that cannabis to the general public. But everything is regulated on a state-by-state basis. And specific to, let's take an example of the cultivation side. You and I, let's say we live in California. We apply to the state of California for a license to cultivate cannabis. We get approved, and now we're off to the races, but we need a building. So we've been successful earlier in our careers. We identify an industrial building for $2 million. We buy that building. It's not out of the realm to have us put $6 million more into that building to retrofit that for to cultivate cannabis. So think about HVAC, irrigation, lighting, high-tech security. So now that building is worth $8 million because we bought it for $2 million and added $6 million to it. And to a cultivation or a cannabis operator, it's probably worth something close to that. But if you're a standard industrial tenant, you don't need 14 air conditioners and state-of-the-art security, right? Nor you don't want to pay for it. Yeah, right. So you don't want to pay for it. And so the way that we de-risk the otherwise risky area of cannabis is we assume that cannabis goes away in every transaction. And in the fund's view, we would come into this particular example and say the building's worth 2 or maybe 2.25. And then we would underwrite a short-term mortgage, think 2 to 4 years in nature. And we'll go 75% LTV on that lower valuation. And so that's allowed us to stay away from defaults inside of the portfolio. So all of our investments and the fund are still current, and we've had zero defaults since we launched.
So you guys aren't financing any of the equipment or any of the retrofitting or any of that kind of stuff.
Correct. We're not financing the equipment. However, what we will do is in the collateral package, we want to take and put as much collateral to protect our investors as possible. So using this example, we would still include that 6 million of improvements, even though we're not providing a value on that.
Right. Okay.
Yeah.
So it's up to the investor, the person that's buying the property, doing the business, to
Mhm.
come up with the 6 million
Correct.
for the,
And also we're not lending to an operator per se. We're simply financing a piece of commercial real estate whereby you, the owner of that, have a cannabis tenant. And because of that
right.
cannabis tenant, you can't go to Wells Fargo or JP Morgan or really any other bank in the States to get a mortgage.
Interesting. Okay. Now, with your experience behind the scenes, what does the business side of things look like for that operator? Because
Yeah,
again, yeah, you're financing the building. You don't want them to go belly up. You don't want the pain in
sure.
the butt of foreclosure or anything like that. So the business has to be solid on the other side. What does
Correct.
that actually mean? What does that tend to look
Yeah,
like?
that's an interesting question because as if you or I were going to buy a piece of real estate, we would have our standard due diligence that we would run, right? Proximity, what's the
Hmm.
geography look like, how many people are living around, proximity to roads, access, etc. But in addition, in our diligence package, we want to ensure that not only is the borrower, i.e., the owner of the real estate, financially secure, but ultimately the tenant of that particular building is going to be the one responsible for paying the rent slash mortgage. So
Hmm.
we diligence the operator. And what we look for in that aspect is we want to see the quality of the management team. Have they been through a market cycle before? What's their financial net worth? Oftentimes we'll get not only corporate, but also personal guarantees on the underlying debt. So we really de-risk it as much as possible, ensuring that our investors have the best possible experience. Now, again, going back to this idea that you can't cross state lines, every state has a different price per pound. And in some states, that fluctuates based on just time of year. So, for
Hmm.
example, up in Michigan, obviously it gets cold during the winter, but during the summer and fall, there's a lot of cannabis that's grown that actually enters the market, and they have a lot of cannabis coming on to, or a lot of supply coming on around October. And because of that excess supply, the price per pound will drop. And so it's
Hmm.
understanding the individual dynamics in each specific market to really understand what the downside scenario is for the tenant and should that tenant be able to continue to operate in a profitable manner as we continue to go forward. And Dave, this is going to blow your mind. And if you or I are, let's say we're operating a dispensary or a cultivation, um, things are changing as we speak, but before cannabis was rescheduled to a Schedule 3, it was a Schedule 1 controlled substance. And as such, you and I, as an operator in cannabis, could not deduct ordinary business expenses. So, said differently, we were paying taxes on gross revenue as opposed to net revenue, which
Oh,
means our effective tax rate could be 70+%. Now, there is some change that's going on. So, President Trump and the DEA, et cetera, did reschedule cannabis from a Schedule 1 to a Schedule 3. That will allow operators to deduct ordinary business expenses on medically grown cannabis. So that gives our borrowers an improvement in their credit worthiness because they have more free cash flow to meet interest obligations. But it doesn't necessarily allow banks to come into the space. So this whole idea of scarcity of capital still continues to be in place, even though cannabis has been rescheduled from a 1 to a 3. In order for cannabis to really take off and banks to come into the area, we would need to have some sort of reform on banking laws there's a bill that's been to the House 9 times. It's failed every time, called Safe Bank or Safer Banking.
yeah.
And once we see that, then we would see an increase in the participants willing to lend into the space. And that will happen at some point, Dave. In our mind, it's still going to be 3 to 5 years out. And so for our investors, this is a timely opportunity to capture the spread between what ordinary businesses can borrow for versus what a restricted capital starved area borrows for.
All right. A couple of questions come to my mind, Chris. I'll put a pin in one of them. um, First question was around the owner operator idea. So, with the properties that you're financing, does it tend to be a separation there? You've got the owner of the property who's leasing it to the operator, or they tend to be one and the same?
So there's a blend. And so we have done deals with a company that their main business is to go around to these different states, buy properties, retrofit those properties, and then lease them out to different tenants. On the other hand, we've had a number of borrowers that are owner operated, but legally they're separate entities. And so never is the entity one and the same, which which kind of said differently, it allows us to still be at arm's length because we're not lending directly to an operator. So we're not investing directly into a cannabis operator. We're just financing a piece of real estate.
That's good. Okay.
Yeah.
Very, very good. So bottom line, the big picture play here is these guys can't get financing from the bank. The opportunity is to provide them with financing. And because of supply and demand, you can get a much better return on your investment because they got nowhere
Correct.
else to go,
Yeah,
basically.
exactly. And to put some numbers around it, we're if you were a coffee shop, you could go to a bank and borrow for probably anywhere between 6 to 8%. When you come to us to borrow because of that scarcity of capital and high demand, we're putting money into the market somewhere between 13 to 15%. And that may sound somewhat egregious, but that is actually on the lower side of some other lenders in the space. Well,
Mhm.
lenders that were in the space, a lot of those lenders had deals that went sideways. And going back to that example of an $8 million building, a lot of our competition over the last few years would look at that valuation and maybe come in with a $6 or $7 million valuation. And when their tenant went out of business and they have to find a
Yeah.
replacement tenant in non-cannabis, now all of a sudden they're looking at a $3 or $4 million loss.
Wow.
Yeah.
Yeah. Hence the conservative underwriting. You're counting on you're financing with the idea that the cannabis place is going to go out of business and what's this thing going to be
Yep.
worth without all of that.
Yeah, and it's
Okay.
listen, at the end of the day, we're this is not a 2 or 3x your money. It's not, multi value add multifamily that you're going to look to get out of in 5 to 7 years with 2 or 3 times your money, hopefully. Well, we're focused solely on providing financing through debt. And because of that, the best we can get back for the most part is our capital, right? So we want to avoid losses at all costs. And I actually should point out one additional aspect. So when we're going through and financing a piece of property, because of that scarcity of capital, we can often negotiate some sort of additional upside, whether that's penny warrants in the operator that we hold on the balance sheet at zero. So should one day those be valued at something greater than zero, it's just a benefit to our investors, or even profits interest. We did 5 dispensaries in the state of Ohio before Ohio went adult use. And when they did move from medical to adult use, the value, so the total addressable market increases, which means the demand increases, which means the value for that permitted real estate also increases. And out of those 5 dispensaries, we had a profits interest on each one of those. 4 of them have sold. The fifth is on the market. And with that, because we are taxed as a REIT, we simply pass additional income along to our investors. And at the sale of those 4 properties, it allowed us to increase the monthly distribution from usually around 10.5 to 11%. We paid anywhere from 12 and a quarter to 16.67. And so it really is this idea of that, yes, we're playing to get our money back and live to fight another day and get the interest along the way. But there is also opportunity for us to earn better risk adjusted returns by incorporating some sort of additional upside for our investors.
So, Chris, dumb question. So these guys, they're buying the properties, you're financing the underlying property. I think you said 75% loan to
Mhm.
value. They still have to come up with, in our example, 6 million
Yeah.
to retrofit the whole thing. How do they typically raise the rest of the money? Or are they just, where does that usually come from?
Usually it's self-funded because we were successful earlier in our career. We do
Mhm.
this deal. It's 8 million. We each have 4 million, and then let's say 6 or 8 months go by, and you come in, Dave, and you say, "Hey, listen, Chris, I have a great idea. Why don't we open a couple of dispensaries and become vertically integrated and sell retail versus wholesale?" And I'm like, "Dave, that's a great idea." But then we look at each other because we have 4 million in and we have extra money, but it would be nice to use somebody else's money as opposed to ours to open these dispensaries. And we can't get a home equity line of credit. We can't get a mortgage. So
Right.
that's when you would come to a firm like ours at MJ REIT, and we would provide that financing. You and I would get the 1.5, maybe 1.6 million out of it, and that would allow us to go and open those 2 or 3 dispensaries, because dispensaries are easier to open. They're
Yeah.
smaller in size, so it's not a 5 or 10 million dollar investment. It could be 600, $1 million. So that would allow us to open those dispensaries and then ultimately become vertically integrated. So that's generally how the
Yeah.
market works. Yeah.
Yeah. So they go in all cash initially and
Yeah.
then they refi later on.
Yep.
Okay. That's making a lot more sense.
Yeah.
So that's one chunk of things that you finance is the actual the grow operation. I don't
Mhm.
know if that's the correct term. Grow ops is what we used to
Yeah.
call it around here. But that's one side. The other side is actually financing the retail side, the
Yes.
dispensaries. So what does that look like typically?
And similar to how we approach the cultivation aspect, assuming that cannabis goes away, we want
Yeah.
to ensure that the location of the dispensary is in a place where if we needed to re-tenant that to, let's say, an AT&T or a Starbucks, we could easily do that given the foot traffic in the surrounding area. So that gets more at the retail side.
Mhm.
How are the demographics? What's the foot traffic around the area? What's the access? Or how many cars pass the store on a daily basis? So we look at all of those aspects. And retail or dispensaries tend to be lower in total cost because it may only take 800 or $1 million to open up a dispensary. And so what we've done in the past is you may come to us and say, "Listen, we need capital to buy these 5 buildings because we're going to open up 5 dispensaries." And in that situation, we would provide the senior mortgage, and of
Yeah.
course there would be some equity required on your end to put down. And then we would just cross collateralize all of those properties into one overall loan.
Okay, that makes sense because relatively speaking, a lot lower risk there. You're not having
Yeah,
to buy
yeah,
all the growing equipment and all that hydroponics and whatnot or
yeah,
whatever's
yep,
involved.
yep,
Okay,
exactly.
very, very cool. So with your funds right now,
Mhm.
kind of what percentage goes to the operation side versus the retail side as far as
Yeah.
money deployed?
From a total AUM standpoint, about 2/3 is in the cultivation or industrial
Yeah.
side, and about a
Yeah.
third on the retail side. And that really is just an outcome that if we do an industrial for $8 million, it's going to be a larger component of the overall portfolio versus a dispensary at $1 million.
Yeah, of course.
Yeah,
Yeah.
yeah. And
Okay.
so I guess for me, it's when I think about the portfolio and what I was able to build for our investors, it's diversification, which is a fundamental aspect to investing. And we're diversified not only from the number of holdings. So we did 35. We've had 8 of those go full cycle. So we have 27 properties in the portfolio today. But we're also geographically diversified. And so we're in 11 states, and we will traffic or look at deals in any one of those 40 state legal jurisdictions.
Very cool, Chris. Well, hey, thanks for explaining how the business works, and
Yeah.
hats off to you for kind of seeing that need in the market and then also seeing how your competition screwed up.
Leaves us last man standing, I guess.
Well, hey, no, that makes a lot of sense. So, if who are you looking to connect with these days, Chris?
Yeah, and so what we're always looking to do is deploy more capital into the market to take advantage of the scarcity of capital. And we raise capital from accredited investors, and those accredited investors, the minimum of the fund is only 25,000, so it's easy to get in. We do have monthly distributions, monthly purchases, monthly redemptions, and we value the fund on a monthly basis. And so for me, when I created the strategy, I really wanted it to be as investor friendly as possible. So this is not a 5 to 7 year lockup for your money. The fund itself is designed to allow you, the investor, to determine when you want to create your own maturity. I will say that we do, I wouldn't say require, but we do recommend that you hold the fund for at least 12 months. If you do redeem within the first 12 months, there is a 5% early redemption fee, but that's merely to dissuade short-term trading. And for us, we're looking for investors that are in the need of diversifying their real estate exposure, because maybe they've had multifamily, maybe they've had a number of other different real estate verticals. And this, cannabis real estate is differentiated and can act as a good diversifier. The other type of investor that tends to gravitate towards us is somebody that's looking for a high monthly income, and whether that's just the understanding that income is a good thing to have, or that they want to augment their current financial situation, and they want to generate some passive income from their investments.
So if people want to connect with you, where should they go, Chris?
Yeah, easiest place to go is to the website at www.mj-reit.com. And for this podcast, we have, if you just do that website and then put /events, that will take you to an event page and allow you to sign up for our monthly distribution newsletter. And if it is of interest, we would love to have a conversation with you and see if it's a right fit for your portfolio.
Sounds good. Well, hey, thanks very much for explaining how this side of the business works.
You're welcome, Dave. Good to have a conversation with you.
All right, everybody. Thanks for tuning in, and we'll see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.